576 million ounces of paper, 76 million ounces of real metal. One coverage ratio sitting at 13.4%. That is the number that deserves your full attention right now. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Silver closed Friday at $75.14 Western spot. Shanghai closed at $86.06. That is a $9.56 premium, 12.5%, for the same metal on the same day. The data is doing the talking. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: COMEX silver. The coverage ratio between deliverable registered silver and total paper futures open interest sits at 13.4% as of the most recently published CME Group warehouse data. COMEX registered silver, the only silver that carries a delivery warrant and can legally be delivered against a futures contract, stands at approximately 76 million ounces. Total silver futures open interest stands at approximately 576 million ounces. That is 7.4 ounces of paper for every 1 real ounce sitting in a COMEX-approved vault. Exchange analysts at BloFin Research flag a coverage ratio below 15% as stress territory, a level historically rare and associated with delivery pressure events. The current reading is 13.4%, below that threshold. The timing is what deserves scrutiny, not the number itself. The timing. The May 2026 first notice day is 4 business days from Monday's open. 34,632 May contracts, representing 173.2 million ounces, remain open according to Gold Silver AI. If 44% of those longs stand for delivery rather than rolling forward, the entire registered stock is exhausted. 44%. That is the break point. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. 1/3 of COMEX registered silver has been removed from vaults since the September 2025 peak. 1/3 gone in 7 months. The last time Western silver inventories contracted at this pace, silver moved significantly higher within 2 contract cycles. The data is already telling you something. Let's build it out. Now let's build the full picture because the COMEX coverage ratio does not exist in a vacuum. XAG USD closed Friday at 75.14, having opened at 75.46, with a session range of 74.68 to 75.94, according to investing.com. Silver is on track for a near 7% weekly decline according to Trading Economics, driven by macro headwinds, not by any change in the physical supply picture. The futures curve sits in mild contango. Forward months are priced slightly above spot. Contango theoretically incentivizes warehouse deposits. It makes economic sense to deposit silver now and sell forward at a premium. But Gold Silver AI data shows Shanghai spot silver trading at $86.06 against Western spot at $76.50, a 12.5% premium, $9.56 per ounce. Asian physical buyers are pulling metal eastward faster than Western arbitrageurs are depositing it into COMEX vaults. Contango does not overcome a $9.56 cross-market premium. It never has. According to BloFin Research, paper leverage stands at 7.4 times, significantly more paper claims than deliverable metal. According to the Silver Institute, cited by finance magnates, this is the 6th consecutive year of structural supply deficits projected at 67 million ounces for 2026. China's imports of silver reached their highest level in 8 years in early 2026. The rate of registered inventory decline is not slowing, it is compounding. That is not coincidence. That is a pattern. The ones who have been called alarmists for pointing to COMEX stress metrics, they are not saying much right now. And here is what makes that picture even harder to ignore. The FindBullionPrices.com Shanghai benchmark data for April 24 shows the morning session premium at plus 12.7% and the afternoon session at plus 11.7%. The 6-month average Shanghai silver premium is 9.96%. The current reading is above that average. The premium is not normalizing, it is widening. At the same time, bullish silver positioning on the Commitment of Traders report rose to multi-week highs as of April 14th, according to Reuters citing Bloomberg data, reported by the Strait. Managed money is adding to long positions while the paper price declines. That is a divergence. Price falling while positioning increases. That setup resolves in one of two ways: a sharp squeeze higher or a capitulation flush lower. The structural evidence, 13.4% coverage, 4 days to first notice, a widening Shanghai premium, and a 6th consecutive deficit year, gives the squeeze scenario more structural support at this moment. Before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now, the Strait of Hormuz, because this is no longer a backdrop. It is the primary variable in this market right now. Here is the number most people are not talking about. Approximately 21 million barrels of oil per day move through the Strait of Hormuz. That strait remains blocked. Both the US and Iran have maintained their blockades of the waterway, according to Bloomberg, creating a standoff with Brent crude extended above $95 per barrel on investing.com data. When energy prices run this hard, inflation expectations rise. When inflation expectations rise, the Federal Reserve cannot cut rates. When the Fed cannot cut rates, the dollar holds firm. When the dollar holds firm, the monetary bid for non-yielding silver is suppressed. That is the transmission mechanism. That is why silver spot at $75 Western and $86 Shanghai can coexist in the same week. The Western paper price is being compressed by the macro channel. The Eastern physical price is reflecting real industrial demand: solar panels, electric vehicles, AI data center build-out, demand that does not care what the Strait of Hormuz is doing. The DXY is holding near 98.5 according to Yahoo Finance data. The 10-year Treasury yield sits near 4.31% according to Trading Economics. The Federal Reserve meets April 29th. The CME FedWatch tool shows a 99.5% probability of rates holding at 3.50 to 3.75%. Markets are currently pricing zero Fed movement. Look at that probability and tell me what happens to the dollar and to silver if even one Fed member introduces dovish language on April 29th. When markets start pricing even a hint of easing, the dollar weakens, yields fall, and silver reprices on both the monetary and industrial channels simultaneously. That is the historical pattern. Every time this sequence has occurred, macro suppression followed by a sudden shift in rate expectations, silver has not been slow to react. It has not been different yet. Silver Western spot is at $75.14. Shanghai physical spot is at $86.06. That is a 956 premium, 12.5% for the same metal. Short-term picture. The paper price is being controlled by the macro channel, DXY near 98.5, 10-year at 4.31%, Fed on hold, Hormuz closed. That is real. That is not a fiction. If those conditions remain through the weekend and into next week, silver stays suppressed near $73 to $76. If the US-Iran peace talks that are active this weekend produce a breakthrough, oil crashes, inflation expectations fall, the Fed pivot narrative returns, and the macro headwind for silver reverses rapidly. If that condition hits, silver reprices toward $82 to $86 quickly. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does Monday morning. Nobody can. Saturday and Sunday are confirmed non-trading days. The geopolitical variable is binary and unresolved. If you think you know what silver does Monday open, good for you. This is a weekend with active peace negotiations and a Fed meeting 4 days out. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Dollar strength near DXY 98.5 continues to suppress the monetary bid for silver. A weekend ceasefire announcement could flush COMEX paper longs rapidly towards $68 to $72. The historical precedent shows the vast majority of May longs roll contracts forward rather than standing for delivery. The bull case is equally real. Shanghai is paying $9.56 more per ounce than the COMEX paper price for physical delivery right now. COMEX registered silver at 13.4% coverage is below the historical stress threshold, with first notice day 4 business days out. The Silver Institute projects a 67 million ounce annual supply deficit for 2026, the 6th consecutive year of structural shortfall. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one structural reality. 576 million ounces of paper claims sit against 76 million ounces of deliverable metal. The May delivery clock is running. The Shanghai premium is widening, not compressing. The only question is whether this contract cycle, or the next one, is the one where the paper and physical markets are forced to reconcile. Don't take my word for it. Verify every number I gave you today. Check CME Group's official daily warehouse stocks report. Check the Shanghai Gold Exchange benchmark data at en.sge.com.cn. Check the BloFin Research coverage ratio analysis cited by finance magnates. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.